Snapshot, first of all, you optimistic for Q4?
You know what? We think there's some room to be defensive here. There's a few things that we're watching as we enter the fourth quarter. First and foremost, the trade situation. Two dates to watch there, October 15th and December 15th, both dates where tariffs are supposed to escalate. Number two, we're looking at what's happening with Q3 and Q4 earnings. While estimates have come down for this year, 2020 still looks optimistic. We could see downgrades in the future. And then finally, and last but not least, the political situation, geopolitical situation, not only here in the U.S. with the impeachment hearing, but in Europe as well with the Brexit situation coming to bear. So a lot of things, a lot of moving parts we're looking for and somewhat worried about.
How closely are you watching yields as to whether that impacts general risk sentiment?
Yeah, generally, what we saw in August was yields probably fell too far, too fast. Yields tend to be a proxy for not only what's happening in the U.S. economy longer term, but what's happening with the global rate sentiment. So our yields are being dragged down somewhat with the negative yielding bonds globally, but we're also looking at risk factors on the economic front. So when our yields kind of stabilized over the past month, it probably was an indication that some of the economic data and indicators have stabilized. We saw that come through. We're seeing the economic surprise indices stabilize. The question mark is, are we going to get that stabilization going into Q4 or not?
When you mentioned trade and potential for downside to earnings forecasts into next year, big question is, what's already priced into the market on that? In other words, are we, would we be terribly surprised if trade doesn't get solved in the next couple of months?
Well, you know what? I think on the trade front, there's less optimism, especially now with the geopolitical tensions and, impeachment overhang. I will say from the earnings perspective, 2020 earnings are still about 10%. And so if that starts getting downgraded to closer to 4 to 6% where we think it should be, we could see some volatility around that. And in fact, what we're looking at this quarter is will the retail side of the business really hang in there like we saw last quarter with the Targets and the Walmarts outperforming, or will we see some downgrades on that front as well? And so that's important to watch, especially in light of trade and manufacturing. And
with trade, is it a big deal if we don't reach an agreement, or is it a big deal if the additional tariffs kick in and we start to see more and more kind of ramping up on both sides?
Yeah, I mean, the best case scenario is we would reach a deal and the tariffs roll back. That's probably the least likely scenario. Another good scenario would be if particularly those December 15th tariffs get pushed back further. Those are the tariffs that are really going to impact consumer sectors. Think apparel, textiles, footwear, toys. So really things that could impact a consumer spending pattern and holiday shopping season. We already had them pushed to December 15th. Right now we're not expecting a further pushback, but if that happens, that would be incrementally positive.
Are you focused much on impeachment possibilities, or is that not so much a factor compared to the election next year?
Yeah, the good news is markets tend not to really discount political noise until something material happens, especially that could be market moving. What we're looking at is, from a process perspective, it does seem like impeachment may not be likely once it hits the Senate. You need the 2/3 vote. That would require about 18 or 19 Republican senators moving over to the yes side, probably a low likelihood scenario. From a market perspective, could this have incremental impact on the headlines, volatility, but also incremental impact on trade? Or the Chinese looking at this and saying, what's our incentive to come to the table when there's additional political turmoil here in the U.S.? So that's probably the market impact.
When you say that there's room here for investors to be defensive going into the fourth quarter, how does that manifest itself?
Yeah, from our perspective, across asset classes, we're up in quality, we're defensive. From equity perspective in particular, we continue to favor that barbell approach. On one hand, the tech story is still interesting to us. It has long-term legs. The areas that we talk about, mobile payments, cloud, cybersecurity. But on the other hand, that defensive side of the portfolio, that includes your staples, your REITs, your utilities, parts of healthcare, just because they've lagged so much. But really important to, it's really helped investors over the last quarter in particular. And even beyond the equity side, areas like dollar, investment grade corporate bonds, even gold, we think is still interesting here. So a good defensive portfolio going into the fourth quarter makes sense.